Without further ado, our first presenter is Jonathan Pogach, who will talk about shared destinies, small banks, and small business consolidation. John is the chief of the Financial Modeling and Research section of the Center for Financial Research Division of the FDIC. His research interests led him to explore the roles of banks' internal capital markets, the effect of banks' dividend policy, consolidation, and technology. And his work has been published in a number of economic and finance journals. John?
Thank you so much, Elena. Thank you for the host for including me in the program. Give me a nice excuse to put on a jacket, which I don't get to do all that frequently these days. This work is joint with Claire Brennecke of the CFPB and Stefan Jesuits at the FDIC, which means that, let me see if I can click through. Hold on one sec, I'm trying to click through my slides here. The usual disclaimer applies. These views are our own and not those of the FDIC, the CFPB, or the US government. So the purpose of our paper and the motivating factor of our paper is really from these two lines. And what this shows us are the trends of small firm employment share and small bank deposit share over the course of what we have so far this century. Now, we can only imagine what these are going to look like over the next few years as we go into 2020. Our study obviously stopped in 2017 as we wrote it and as the data was available. But we can think about how these trends are going to continue with the coronavirus. So in particular, the blue line is showing us the share of employees that work at firms with less than 250 employees in the U.S. economy. So at the beginning of the century, we saw that rise slightly, and then has kind of continued to fall since kind of the early mid-aughts of the century. The red line shows us the share of deposits held at small banks, which for the purposes of this talk is going to mean $1 billion of assets or less. And that too has fallen, and that's pretty continuously fallen from the beginning of the century. And like I said, just think about what these next few years are going to bring us. Next slide. So the way that the literature traditionally thinks about this is it says, well, we have consolidation in the banking system, which are driven by maybe tech regulatory changes. I've listed some of those regulatory changes above. Technological changes, the advance of the ATM, changes in credit scoring methodologies. And combined with the fact that small banks have a comparative advantage in lending to small businesses, well, if we see small banks consolidating, what is this going to mean for small businesses? It's going to mean that the relationships between those small banks and those small businesses are getting pushed out, and this is going to restrict the supply of credit to small businesses. So the way that the literature usually thinks about this is small bank consolidation is leading to the loss of small business finance, and therefore that's part of why we're seeing this trend in small businesses. Next slide. So in a picture, this is what the literature has to say. If we think about some county C, and we have small firms that are paired with small banks, and these are the relationships, small firm one with small bank one, etc. And then we have, outside of this county, we have national banks that provide credit to national firms. Next slide. Well, what happens when a national bank takes over a small bank? Well, that potentially severs the relationship between small banks and small firms. And then what's that going to do to credit access for the small firm? Traditionally, the way that the banking literature looks at this is to say, well, that small firm is now more likely to get into trouble because it's losing its access to finance. Next slide. What we do in this paper is say, well, maybe it's also happening in the other direction. So there's a newer literature in economics and finance that talks about the consolidation of real industry. We can think about this as being driven by technological changes. For example, changes into supply chain management might make big box retailers more successful than smaller retailers over this time period. We've obviously seen changes to e-commerce and the ability of businesses, especially larger businesses like Amazon, to conduct business. And also we have changes in the regulatory system. There's literature that talks about changes in antitrust prosecution. Well, if we take the same narrative that small banks have a comparative lending advantage to small businesses, this is where their business is, what we say in this paper is maybe it's going the other way. Maybe the loss of small businesses is part of what's changing the viability of small banks as they lose their customers. Our story is not mutually exclusive from the other story, right? It could be going in both directions at the same time. And when we think about why this is important, I think this discussion was highlighted earlier. Let's think about the COVID recession as it's happening now and the ensuing government responses. All of these actions and all these events are going to have dramatic effects on the role of small businesses in the economy. And through the mechanisms that had just been spoken about before we came on, what is the effect of all this going to then be on small banks? Next slide. So if we think about that same picture before, we had how the literature thinks about it. Well, how we think about it is very similar. We have small banks and small firms that are paired. They have these relationships. We have national firms that get their credit from national banks or from capital markets. Next slide. What happens if a national firm, for whatever reason, is able to push the small firm out of business? Next slide. What now for the small bank that had these small firms as its customers? Next slide. So what we do in this paper is we try and get at how we can show that really this is what's happening. How can we show that it's small businesses that are in part impacting the consolidation of small banks? And what we do is we try and estimate this effect using data from census, something called QWI data, quarterly workforce indicators, and we use FDIC summary deposits data to try and establish the causality from one to the other. And the way that we do this is through something called a Bartik instrument, which I'll explain in a couple slides. And all that means is we have a chicken and an egg problem. Which one's coming first? It's hard to know. And economics, a lot of our work is trying to disentangle how can we show that one is causing the other. Next slide. So a little bit about our data. We use quarterly workforce indicators, which is census data. And this tells us, among a number of things, the county level employment growth by firm size. So we can see how much are small firms growing in a county, how much are larger firms growing in a county. It also tells us how much industry exposure we have at the county level. Is this county more reliant on agriculture? Is this county more reliant on manufacturing? We also use SOD data, summary of deposits data, which tells us, loosely speaking, the location of bank branches, deposits, and we construct a number of measures using that data to try and understand what the small bank proxies look like at a county level also. Next slide. So how does this Bartik instrument work? So how is it that we're going to try and convince you, the reader, that really what we're picking up on is small businesses driving small banks rather than the other way around? Well, let's suppose let's look at my home county in the year 2000 and my co-author's county in the same year. Well, my home county, we've got some really big hospitals. We've got some smaller healthcare providers that are built off of that hospital system. And my county has a pretty big healthcare focus. We also are located near a major metropolitan area, so there's a major metro county. So we have a lot of warehousing needs that are in my county. So my county is pretty heavy in healthcare and transportation. We have some retailing and manufacturing also. My co-author Stefan, his home county is a little bit less on the healthcare and the transportation and a little bit heavier on the retail and manufacturing. Now, what if I told you that in the subsequent 15 years, I'm going to leave a little bit of a gap for reasons that aren't worth getting into here, but over the subsequent 15 years, healthcare and transportation saw a lot of small business employment growth, whereas retail and manufacturing did not see the same level of small business growth. What would we expect to happen to small business financial service demand in my county relative to Stefan's county? Well, the Bartik instrument is basically trying to tell us something about that. It's trying to say, well, given the national trends that we see, we expect that the demand for small business finance in John's county is going to grow more than that in Stefan's county. And that's how we try and establish the direction of the small businesses causing the small banks consolidation rather than the other way around. Next slide. So the main findings of our paper is that a 1% increase in small firm employment growth is associated with a 0.9% increase in small bank deposit growth. So there's really this symbiotic relationship. It's almost, it's too good to be true almost for us as researchers that we get such a natural correspondence of almost one-to-one. So we see small firms grow, and we see small banks kind of grow in tandem. We also find that small firm employment growth leads to higher small bank income. We find that this is largely through lower provisioning. We also find that increases in small firm employment growth are associated with more small bank, small C&I lending. And we also find, to a lesser extent, but to some degree, that increases in small firm employment growth are associated with increases in residential real estate lending, which may serve as an alternative venue for small businesses that are relying on their personal wealth. We don't find that large firm employment growth is associated with small bank deposit growth, so there really is something special about the relationship between the small firm growth and the small bank growth. Next slide. So what drives our findings? So we go into the paper a few different possible reasons where this is coming from. We might think that as small banks, as small firms, are more profitable, it might be that they are less likely to be acquired. They're less attractive targets for large banks where economies of scale matter more. They might go and look to acquire other small banks, and they might be more or less likely to fail as the result of small firm employment growth. Next slide. What we find is that really the result is primarily coming from the likelihood to be acquired. So we were basically finding that as small firms grow, the small banks are more able to stay in business and not need to find an acquirer to help them out. Next slide. So we go into some additional findings in the paper. We find that our results are stronger for more urban areas. So this is consistent with extant evidence that small banks, relatively speaking, are performing better in more rural areas of the country. And we also find that our results are stronger where banking markets are more concentrated, where we expect the relationships to be stronger as there's fewer competitors. Next slide. So to conclude, our punchline is that the composition of the banking industry really depends on the composition of the real economy. This almost seems obvious on its face, yet we think we're one of the first people to actually demonstrate this. Combined with existing literature, this suggests that we have a feedback loop between the two. So it's important when we think about policies that really small bank policies or policies affecting small banks are really interdependent with the policies and trends that we see in small businesses. And that is my time. Thank you very much for your attention.